Every few years, the market gives us a familiar feeling. Not panic, not euphoria, but something quieter. That moment where prices keep climbing, headlines stay optimistic, yet somewhere in the background, the numbers start to feel stretched. That's where we are right now. As we move toward 2026, tech stocks are once again leading the market. AI names are dominating headlines. Mega-cap companies are larger than entire national economies. And retail investors are asking a simple question: is this still growth? Or are we setting up for another correction? To answer that, we need to slow down and remove the noise. Because market corrections don't arrive with sirens. They arrive while things still look fine. Let's start with valuations. Over the past 2 years, tech stocks, especially in the US, have expanded faster than earnings. Not collapsed fundamentals, not shrinking revenue, just prices running ahead of reality. When investors are willing to pay more today for the same dollar of future profit, that's not automatically wrong. It usually means confidence. Confidence in innovation, confidence in margins, confidence in long-term dominance. But confidence has a limit. By late 2025, several large tech firms are trading at valuation multiples that only make sense under one assumption: that growth stays strong and uninterrupted. No slowdown, no margin pressure, no regulatory friction. History tells us that markets rarely reward assumptions that clean. Now, compare this to what's happening underneath the surface. Revenue growth for many mature tech companies is slowing. Not collapsing, slowing. Cloud growth isn't what it was in 2020. Hardware cycles are stabilizing. Consumer tech spending is normalizing after years of pull-forward demand. Yet stock prices are behaving as if we're still in hyper-growth mode. Artificial intelligence is real. It's transformative. It's not a bubble in the traditional sense. But the pricing of AI potential may be running ahead of its timeline. Right now, markets are rewarding companies not for AI profits, but for AI possibility, for being adjacent, for mentioning it on earnings calls, for promising future efficiency that hasn't yet shown up in margins. That doesn't mean AI fails. It means expectations might be too front-loaded. When expectations peak before earnings do, stocks don't crash. They stall, they drift, they correct quietly while narratives stay optimistic. And that's often more painful than a sudden drop. Another factor investors aren't talking about enough is interest rates. Even if central banks begin cutting rates in 2025 or 2026, we are not going back to zero. The era of free money is over. Higher for longer doesn't kill tech companies, but it changes how markets value future earnings. Distant profits become less valuable. Long-duration growth stories lose some shine. That matters most for tech. In the US, UK, and Australia, institutional capital has been heavily tilted toward growth for over a decade. Portfolios are crowded. When positioning becomes one-sided, even good news stops pushing prices higher. And when that happens, markets don't need bad news to fall. They just need silence. Now let's talk psychology. Corrections rarely happen when investors are scared. They happen when investors feel safe, when volatility is low, when dips are bought automatically, when "this time is different" doesn't even need to be said anymore. We're not at extreme greed yet, but we're close enough that caution is starting to matter. This doesn't mean 2026 will bring a crash. Corrections aren't crashes. A correction is the market exhaling after holding its breath too long. And tech, right now, has been holding its breath. The final piece is global risk. Geopolitical tension, supply chain refragmentation, rising defense spending, and political uncertainty in major economies all add friction. None of these individually break markets, but together, they reduce tolerance for overvaluation. When risk increases, markets demand a margin of safety, and expensive stocks don't offer one. So the real question isn't if tech is strong. It's whether tech stocks are priced as if nothing can go wrong. Because when markets price perfection, even excellence can disappoint. So if a correction does arrive in 2026, what would it actually look like? Probably not dramatic. No 2008-style collapse. No sudden wipeout across the board. More likely, it's a slow recalibration. The kind where markets move sideways for months. Where strong companies go nowhere. Where speculative names quietly lose 20 to 40% without making headlines. Where investors feel frustrated, not frightened. And that's important because sideways markets are where most people make mistakes. They overtrade, they chase momentum, they abandon long-term plans because nothing is working. Now, Let's break down which areas of tech would feel the pressure first. The most vulnerable segment isn't profitable tech, it's promised tech. Companies with strong stories but thin margins. Businesses trading on revenue multiples instead of cash flow. Firms whose valuations assume perfect execution 5 years into the future. These stocks perform beautifully when liquidity is abundant and confidence is high. But in a correction, markets become impatient. They want results now, not projections. That doesn't mean these companies disappear. It means their stock prices come back to earth while the businesses continue to build quietly in the background. On the other side, mega-cap tech may look safer, but even they aren't immune. When companies become systemically important to the market, expectations rise. Every earnings report becomes a test. Beating estimates isn't enough anymore. Guidance has to impress. And when growth inevitably slows, even slightly, valuations compress. That's how great companies deliver disappointing returns for years at a time. Now let's talk about who might actually benefit. In past corrections, the winners weren't the loudest innovators. They were the companies with pricing power, recurring revenue, and boring reliability. These businesses don't double overnight. But they also don't collapse when sentiment shifts. They compound quietly. And in markets like the US, UK, and Australia, where pension funds, superannuation, and institutional capital dominate, quiet compounding eventually attracts attention. Another overlooked area is balance sheet strength. When money isn't free, cash matters. Companies that can fund growth internally gain an advantage. They don't need to dilute shareholders. They don't rely on friendly markets to survive. In a correction, those differences become visible. Now here's the part most people miss. Corrections aren't a signal to run away from tech. They're a signal to become selective. The biggest mistake investors make is treating tech as a single trade. It isn't. It's an ecosystem. Mature businesses, emerging platforms, infrastructure, tools, and experiments all mixed together. A correction separates them, and that separation creates opportunity. Not for traders chasing quick rebounds, but for investors willing to wait, because innovation doesn't stop during corrections. Engineers keep building, products keep improving, margins quietly expand once expectations reset. By the time markets feel optimistic again, the best entry points are already gone. That's why timing the market rarely works, but understanding the cycle does. So are we heading for a tech stock correction in 2026? Maybe. But the better question is this: if we are you prepared for boredom instead of fear, patience instead of excitement, process instead of prediction? Because the market doesn't reward intelligence alone, it rewards temperament. The next phase of tech investing won't be about spotting the next big story. It will be about recognizing durable businesses at reasonable prices and having the discipline to hold them while nothing seems to be happening. And when momentum finally returns, it won't feel obvious. It never does. If you found this breakdown useful, make sure to subscribe for more long-term market insights that focus on clarity over noise. Like the video if this helped sharpen your perspective, and share it with someone who's trying to understand where tech might be headed next. Thanks for watching, and I'll see you in the next one.